Good morning and welcome to this secular market update. Now, before I get into it, everything we cover here today is of a general investment advice nature, not personal or specific investment advice. And past performance is no indicator or reliable indicator of future performance. Right, what are the objectives of this session? Well, often, all the time, not often, all the time, we get sucked into short-termism. And the idea of this session, done twice a year, is to step back, look at the really, really big picture and see where equity markets are placed in from a big picture perspective, and to not, if you like, suck ourselves out of the short-termism and see where things may go, but also where they've been, and try and learn from history so we can better position ourselves for the future. So it's technical analysis I'm using, but I'm also using cycle analysis, and there's no fundamentals in here. This is purely price action. You're looking at the movement of stock market prices and the cycles and the technical analysis that comes from that. I've already said this. Past performance is not a reliable indicator of future performance, but undeniably trends and cycles exist. Even if they don't repeat exactly, they are similar enough, they are close enough for us to learn a lot from what has happened in the past. And they also, so often, they persist and they repeat more closely to they have historically than what we would like to give credit for. And when you have spent years and years looking at charts, you get to see how close the similarities are. And that's what we want to learn from. So the big question, and I'll certainly answer that today, is the secular trend still up? Is this long-term secular trend still up? Now, what do we mean by secular? Well, long-term, ultra long-term. I'll put that into perspective in a moment with shorter term. A little bit of background. I've been told that I don't make enough, I don't emphasize this enough, but a little bit of background. Back in February 2013, I wrote a blog which was published in the Australian Technical Analyst Association journal. And what the title of that blog, that writing with graphs and everything attached and a whole lot of analysis, quite similar to what you're going to see here today, but obviously backdated to February 2013, was history-making event on the horizon. And that event occurred a couple of months later in the third week of April, where a breakout to a new all-time high occurred. And as you'll see in the graphs, I'm going to show you that the two previous attempts of that breakout to a new all-time high over a 13-year period failed dismally. And we had a 50% plus, a 50% and a 50% plus retracement in the S&P 500. And that was the secular bear market. And then we had a breakout. And ever since, that was the start of the secular bull market. And ever since then, I've been covering this event and what's happened since then in blogs and webinars like you're going to see today, providing updates with answering that main question: is this secular bull market still intact? Now, a point that I haven't, I think, emphasized, I'm told, even though it sits in my head all the time and on a daily, weekly, monthly basis, is that I haven't emphasized this enough, is that the secular market cycles, for the time frame, if you like, for how long human beings exist on the planet, should be the overriding theme for every investor. Now, longer term cycles most certainly do exist. They talk about, there's the Klondike cycle, which goes 54 years, and then there's 100-year cycles after that. But looking at those to be able to make money and grow profits and protect our money in the stock market and the timeframes in which we have capital available and how long we live really are not as important as the secular market cycles. They should be our overriding theme in the back of our minds all the time. Right, before getting into the cycles, just want to mention the one other cycle, which is not stock market related, but it does seem to have an effect, as the stats and the history show us, on the stock market, and that is that we are currently in the third year of the presidential election cycle, and that has stood out to be the far better year from a returns perspective over nearly a century now, even longer than a century if you go back to that. And in 2019, the last third year of the presidential cycle, were two stellar years on the stock market. Now, that doesn't mean, because we're looking at averages here, that doesn't mean that it's a guarantee to happen this year, but it is one of the sentiment, if you like, indicators to take into consideration. And I'll cover a few more of those sentiment indicators, another 4 of them, a bit later in the session. Before I do that, let's talk about the wall of worry. The wall of worry exists all the time, and effectively, there's an ongoing tussle between the secular cycle and even shorter term cycles, the primary and secondary cycles, and bull and bear markets versus the wall of worry. That's the ongoing arm wrestle that's happening all the time, because there is worry in the world all the time. And the worry is what gets accentuated by the noise that comes from the media and commentators and everything that hits our senses that we live in on a day-to-day basis. And that wall of worry, because it's accentuated and emphasized, is what can take us off our longer-term plans. And that is why it's so important to have the secular cycle sitting in your mind all the time, because it steps you back into a bigger picture perspective, and is one of the key things, that perspective is one of the key things to help you overcome all of the short-term wall of worry events and things that go on all the time, the noise. So let's just go through a few of them quickly. Government debts are rocketing higher. Over the last 3 years or so, governments around the world have, particularly in Western world, have really smashed their debt. They've piled on more debt to the extent that around about 30% of Australia's government debt has just been given out, handed out to citizens and businesses. It hasn't gone into infrastructure or been invested. Some people might say it's been invested in human capital, but I would argue that we would have got back to full employment anyway without having spent that money. But that's an argument for another day. The fact is that big chunks of government debt around the world have just been given away without being invested anywhere. New taxes are being discussed and implemented the world over, record high, and there's all sorts of new infrastructure that the world's transitioning to that's also rocketing up this debt. In the meanwhile, we've got inflation and interest rates are rising the world over, and you're seeing almost on a daily, weekly basis reactions to what's happening with inflation and rising interest rates. And as a result of this, all of these wall of worry things, we've had crypto company failures, the largest of which has been FTX to date. And now we've even had bank failures in the last week or so, and bailouts are being spoken about by governments in both the US and Europe. And overnight, we saw what happened with Credit Suisse as well. And this certainly is an outcome of what's going on. And it adds to the wall of worry. And people tend to accentuate these and emphasize them and bring them into their decision making in terms of what they should do in the short term with their money. And what it actually does is distract investors from their long-term plans and their long-term goals. And what we got to try and do, we got to try and keep our focus and our eye on the long-term prize and continue to execute according to how the plans we put in place. And so we get the commentators lap the stuff up. Why? Because it's bad news. Commentators love bad news, and they want to propagate bad news because what does it do? What does it do? It causes fear, uncertainty, doubt, and that's what sells their media and keeps people tuned in. And that noise is getting louder and louder at the moment. It seems that no matter how long you've been in this caper of investing in the market, that the noise just seems to be getting louder and louder. How loud can we accept? The R word has been thrown around a lot. In fact, some would argue technically of my past historical definitions that the US is already in a recession, but that's been bandied around a lot. Dr. Doom, he's been talking about for some time now, and I mentioned this in the last secular bull market update I provided. He's termed it the great stagflationary debt crisis. And now he's talking about debt crisis. And they call him Dr. Doom because he predicted the 2008 GFC, global financial crisis. He predicted it, and he's been given credit for that. Problem is, he started predicting it about 12 years before it actually happened. And we had another big bear market before that, which was the tech wreck, which he didn't predict. So predictions eventually do come true. The problem is we don't know when. And if we react to the Dr. Doom and all the negative noise now in the short term, and we get feared into inaction, then we take ourselves out of the game. And of course, if it's 12 years from now before this happens, then effectively we've lost out on the opportunity in the meanwhile. Now, we don't know what's going to happen, and we don't know when it's going to happen. But if we have a plan in place to protect ourselves, that doesn't take us out of the game until it actually happens, that's how we solve the problem, not by reacting to the noise. Harry Dent's been on record now for some time saying that there's going to be an 80% decline in the stock market. I mean, these are secular bear market type outcomes. And that is why I've got to put them up here, because effectively, if we have an 80% decline in the US market, we were in secular bear market territory well and truly before that. And I'll give you some indications of what those thresholds might be to actually signal to us that we are heading into a secular bear market at the moment. Stan Druckenmiller, who is a famous mechanical investor, but also has made some big calls in his time, he's saying stocks are going to be flat for 10 years, which effectively is the definition of a secular bear market. And Dan Ferris is also saying the same thing. He's a guy that I follow. He's a fundamentalist. I keep challenging myself to see if I should take that into consideration, and haven't been convinced yet for a couple of decades now. But anyway, he's talking about sideways for decades, like Japan, 1989 current. So he's talking about longer, 20, 30 years of a secular bear market. So this noise is around, and it's getting louder and louder. We're seeing more and more of this. So how do we react to this when these people are talking about bear markets that are longer than the time frame we have left to invest? So how do we operate in this environment? How do we structure how we think, our psychology, and how do we structure how we execute in the market? So I'm going to try and cover a bit of that today in the short time that we have available. Some quick market valuation ratios, fundamentals, if you like, the Buffett ratio, which is the S&P 500 to GDP ratio in the United States. We've seen a bit of a decline in that of recent times, but it's still at what you'd term overbought levels, where we're at higher levels than what we'd want. You'd actually want to see the S&P 500 lower relative to GDP, but we're certainly not as high as we were in the roaring 20, coming into the end of the roaring 20s and leading into the 1929 stock market crash. But that doesn't mean that it's going to be all sun and roses from here. It's still at relatively high levels. So that's one indicator, one market, and there are a ton of these. I'm only putting up one or two. You could go and spend hours and hours and even days and weeks looking at all the different market valuation ratios. But at the end of the day, all of that leads into price, because the people that follow this stuff are making decisions on what to buy and sell in the market. So at the end of the day, if all these market valuations are saying that everything's overbought, but the market keeps on going up, well, then the market's going up. And that's what we got to take advantage of those trends when they occur, and not be noised out of actually taking advantage of the opportunities that are on the table. Using the Shiller PE CAPE ratio, which is just really a rolling 10-month, a simple moving average of PEs. This also shows overvaluation as well. And you can see sitting at 30.4, that blue line going through the middle there is roughly the average. It's an eyeball average. It's not an exact average. It may be a wee bit lower than 25 as where I've got it. It could probably be somewhere between 20 and 25 might be that average. And here he does have longer term data for this, which you could go and avail yourself up if you just Google it, and you can go and look at all these data. And this is the red dotted line is long-term interest rates, the average of which over the long term, and that is an average that I took all the data and averaged it out at, is around about 6% is where long-term interest rates have been over the last 100 years or so. And we can see that we are rising, even though there's a long-term downtrend. If you put a trend line on that, you probably find we've broken out above the trend line. A little bit of a tick down from the last time I showed this chart, and you can go to this multpl.com and look at a whole bunch of Shiller data if you want to, all more fundamental than that. So there's a couple of valuations that I've brought up here showing that things are probably from a stock market index pricing perspective overbought still at this stage, indicating that we should be going lower. Now, you can see that since 2010, or even probably around about around about 2015, we've been at overbought levels. So these overbought levels can actually remain overbought for long periods of time and persist far longer than what we may think, in the same way as it can the other way around as well. Right, some terminology before I get into a couple of charts. This is really revision for those of you that have seen this before, but it's handy to have this because, as I said to you, this should be a theme, an overriding theme. The pictures I'm going to show you after this, over the next 4 slides or so, after this, the terminology definitions here, are pictures that you should have in your head all the time as an investor in any stock market. And that is why it's important for me to be, if you like, to keep you honest and to keep building that picture in your head, to keep showing you these pictures every 6 months or so. But you can certainly do this your own. Those of you that have Beyond Charts, these are saved charts that you can actually download the analysis for, and you can look at yourself whenever you want to. But I'm here to be your accountability buddy, if you like, to keep bringing it back to the fore, when the noise starts getting too loud for you and you start making, short-term decisions. So, sorry, a secular bull market, approximately 17 to 18 year cycles, and you'll see that in the charts in a moment. Primary bull bear markets, roughly 1/2 to 2 year cycles, and are technically defined by a greater than a 20% rise or greater than a 20% fall in the market indices. And some people call them, I've always called them primary bull bear markets. They're also called cyclical bull bear markets as well. And then you get secondary bull bear markets, which operate at a shorter time frame, anything from a few weeks to 6 months. And we're not going to be getting down to that level today, but just to be aware of them. Excuse me. And as I said earlier, this wall of worry, arm wrestle that's going on against and versus, if you like, the secular market cycle is in play all the time. And this is what you really need to understand when the noise starts getting to you. So remember, just try and get these pictures that I'm going to give to you in a moment into your psyche. And whenever you feel like you're being challenged through any short-term volatility, go to the picture in your head and just see where we are in this big picture cycle. So there's the S&P 500, 1930 to current. And I'm just going to point these out very quickly for those of you that it's revision. Just bear with me quickly. For those of you that are seeing this for the first time, you can come back and watch this in more detail in the recording. But for those that have seen it many times, I'm going to go through it fairly quickly. Secular bear market lasted 20 years with a maximum fall of 60% over a 5-year period back there in the 1930s. The next secular bear market lasted 13.8 years, and then between the blue support and resistance lines, the biggest fall was a 49% fall, which took 1.7 years to actually play out. And then there was a 36% fall, which took 1.5 years. And then the most recent secular bear market lasted 13.1 years. The breakout was there in April of 2013, which I mentioned. And this is the chart that I looked at to do my analysis when I said that a potential big event was on the horizon. We were right. We were getting close to that breakout. And what we had to see is whether the breakout occurred or whether we had another full breakdown retracement into the range again. The breakout occurred and off we went, just like practice and training had happened before, and looking at the historical record. Two 50%, one slightly below and one slightly above or larger than a 50% drawdown in the S&P 500, then the breakout, and now that's where we are at the moment. So this picture you should get in your head, but you shouldn't just see the red in your head, you should also see the green, and that is the secular bull markets that occurred between the secular bear markets. So that 465% rise from breakout, we'll look at what it was from the bottom there in a moment, but from the breakout is where the secular bull market starts, not from the trough that's in the secular bear market. Secular bull market starts at the breakout, finishes now. The tough thing is we don't know when that occurs. We only find out later when that occurs. And in the same with that secular bear market there, the challenge for us now, which is what I'm going to come to in a moment, is to work out whether the secular bear market has started or not. So if it has, then we could be somewhere around there or somewhere around there. And we don't know that yet, but we'll give some indications at the moment. But for 465% rise in 18.3 years, the next secular bull market was a 1,200% rise in 17.6 years. And we are currently 9.9 years into this current secular bull market, and we've had 144% rise. I won't comment on that for the moment. I'll let you draw your own conclusions through what we go through. So let's just work back now and see where the other secular bull markets were after 9.9 years. So we're 144% into this one. The previous one, after 9.5 years from the breakout, was a 250% rise, and the one before that was a 202% rise after 9.9 years. So you might say that the markets are dragging their heels a bit compared to relatively where they were in the last two secular bull markets. Now let's look at from the trough. Okay, from the trough, the last trough of the secular bull market leading up to the breakout into the secular bull market. So a 470% rise over 14 years. And this is the one that people have been saying, oh, we've been in a bull market for, back in 2014, they were saying it was 5 years, 6 years, 10 years. It's 10 years from there. They were measuring from the wrong place. They've got to measure from up here. And people have been calling the end of this bull market, if you like, has been going since March of 2009. They've been calling it every year since 2014. We were only a year into the breakout at that stage. But then, of course, they didn't have this big picture in their minds. We've had the COVID crash, which was a 33.9%, lasted 33 days, smack in the middle of this. And the last secular bull market, going back to the trough that was in the bear market, that was a 25.5-year trend, if you like, long-term trend with a 2,353% rise. And in between that, right in the middle of that, we had the 1987 crash, which was 33.5%, not that too dissimilar to the COVID-19 crash. Secular bull market before that, from the trough, the last trough in the secular bear market, was a 1,300% rise over 26.7 years. And we are 14 in. So, so are we, so how long have we got left to run? Well, it could be anything between, it could end tomorrow. We don't know, because things don't, or we might be in it. We don't know. But we have some indications and probabilities of where we are, but no dead certs. But just looking at the time cycles that have been running here, we could still have another 3 to 3.5 to 12 years to go in the secular bull market, somewhere in between there. But we have to stay on our toes, to see where, possibly when it could end, but we're not going to know with any certainty. On the flip side, that's handling the negative side. When's it going to end? Is how do we position ourselves? And I want to talk a bit about that in a moment, because we can't let the short-termism take us out of the game, and the volatility that happens and the noise, the louder and louder noise, because there could be a lot of potential still left in the financial markets with these 33, 26% falls. As you can see, the Kennedy slide happened in 1962. That was a 28% fall in that lasted quite a lot longer in that secular bull market. So we're going to have these 20 to 35% falls in the middle of a secular bull market. That's pretty normal and natural. And what we have to do is position ourselves on how to handle those without taking ourselves out of the game and out of the opportunity flow that's just on offer all the time in the stock market. So those pictures, get them in your head, because there really should be the overriding theme sitting behind all of your investing decisions and how you position yourself. Right, quote for the secular market update, which I'll keep, Sir John Templeton, which I keep repeating these because I think it's so relevant, is bull markets are born on pessimism, grown on skepticism, mature on optimism, and die on euphoria. I still believe that I've been saying this for some time, we're still in the skepticism phase. I don't believe we've got into optimism. Optimism leads into euphoria, and this is one of the indicators, if you like, from a market psychology perspective, is that we haven't had any really top euphoric times. If you go and think of what happened leading into the tech wreck, there's certainly been some euphoria in other markets, like the crypto market. There's been euphoria in there's no doubt, but that hasn't been led by just overriding optimism on a mass scale going right across the market where everybody is in the market. That hasn't happened in this last 14 years. And so that's one of the things we've got to be looking out for. It's a sentiment indicator, if you like. We've got nothing ready to show and graph it. It's one that you just have to get from being vigilant and being a groupie, in the markets, you'll pick up on the optimism, because everybody will be talking about it at dinner parties, and then it'll grow into euphoria, and there'll be teenagers and kids and everybody talking about it. We had a little bit of that, when we had the 20-year-olds in the market coming out of COVID. They were sitting at home, not being able to go anywhere, and they got interested in the market. There was definitely a little bit of euphoria there, but not to the extent that we'll have before the secular bull market ends. Right, now analyzing the cycle is easy to determine the start, which I did back in February, March, April, or said keep an eye on this may start, and then it happened, and of course we had the small retracements, and we had the higher highs and higher lows that came out of that, and that's pretty easy to pick if you had the knowledge and the skills, and certainly to talk about, like I have been for some time. It's difficult to determine the end of the secular bull, because we're going to have been in it for some months, maybe years, before we actually say, yes, we're in a secular bull market. And what we don't want to do is take ourselves out too early, because we think we're in a secular bear market and it's overs. But anyway, we also need to talk about how to invest in a secular bear market as well, because that's going to come. And should we be that afraid and frightened of it? Well, I'll leave that to you to determine before the end of this presentation. In my view, you shouldn't be, because you can actually do just as well, if not better, in a secular bear market if you arrange your affairs, your investing affairs in a certain way. So what we keep doing is looking for objective signs to potentially alert the end. And we keep looking at these. We're vigilant. We have to look at them every day. They probably should be looked at on a quarterly basis. Is probably the most regular you should look at them. But most certainly on a 6 monthly and annual basis, they should be revisited. And that's what we do, and that's what I do here at ShareWell Systems and share with our clients. Okay, let's look at a number of technical indicators first. The 14-month RSI is one that's relatively new to my bag of tricks that I look at to analyze the secular bull bear market cycle. And it's one that I can't remember his name, that another analyst in the United States uses a bit, and I've incorporated it into this analysis. So here we are going back to 1929 again, and we're looking at, this is the 14-month RSI, and we're looking at these thresholds, which you'll see what they are in a moment when we get to the right-hand side of the chart. And during this secular bear market, we regularly had the RSI 14 below this lower threshold, and it struggled to get above the upper threshold. Then during the secular bull market, it didn't get below this lower threshold, which I'll show you what it is in a moment. But during the next secular bear market, it fell below this lower threshold, the RSI 14-month RSI. And then again, in the next secular bear market, that lasted through to 2013, from 2000 to 2013, it also fell below a number of times. You can see the indication. There was an early indication there, even though we weren't into secular bear market territory, hit the top, and then certainly that trough took it into below the threshold, and the second down leg below the threshold. Here in 2001 roundabouts, you can see that there was an early warning there. We wouldn't have known when that red line hit over there that this was actually secular bear market. We would have just thought this is just a normal retracement in the ongoing secular bull market. But there was an early warning, and then it continued to fall, and we got this drop, these two drops below the lower threshold. So where is the 14-month RSI now on the S&P 500? Well, it's still well and truly above. What we don't know is if this little retracement that we have here is what we are seeing at the moment. And we've got to just look at these indicators that I'm going to take you through today, and the price action, to really come up with a decision, if you like, based on probabilities as to whether this is what's going to happen, or whether we're going to make a new all-time high and this is what's going to happen. And of course, if this trend, this long-term secular bull market trend continues up, we will make a new high, and we want to be in the game when that happens. Otherwise, relatively, we just really are going to lose out on growth, and you're going to miss out, basically. So we don't want to take ourselves out of the game, but we want to stay alert and vigilant to what's going on. So according to the 14-month RSI, there are no early warning signs yet, like we had back here. in around about 2001 that this could potentially be a secular bear market that we've started in. So using that indicator, secular bull still intact. Let's have a quick look at it on the Dow Jones to get a confirmation of this analysis. And similar sort of thing, you can see, and you've got more data there going back to 1896. You can see that secular bear market that occurred through the 1910s. The 14-month RSI was regularly below and battled to get above that threshold. And again, in the secular bear market that occurred after the 1929 crash, similar. Look, there was an early warning signal here on the Dow well before we hit that peak. And then during that secular bear market again, and then in that's the 1960s and 70s, and here in 2000 through to 2013, also fell below. Where is it now? It's above. We haven't even had an early warning signal. Even with the COVID crash, it did not go below this threshold, which I think on the Dow is 35. Right, what was it on the S&P 500? Was also around about 35. There it is. Okay, let's have a look at the NASDAQ composite to see what the 40-month RSI is. We don't have as much data there, but certainly this data starts in 1970, late in 70 or 70s, I think. That secular bear market certainly below early warning signal here in 1987, or what is that, 89 or so. But the secular bull continued, didn't have a confirmation there with the S&P 500. During this secular bear market, well and truly below. Where is it now? It's above. Even with this pullback that the NASDAQ has had, still hasn't transgressed the lower threshold on the RSI, 14-month RSI. And I think that's around about 38 or so, thereabouts. So based on those, on the RSI, 40-month RSI, we are still going all right, still intact. Right, let's look at the CBOE equities. There are a number of put-call ratio that use volume on put calls. So that's the puts and calls are right across the market for all the stocks that have them. Then there's the S&P 500 put and call ratio, and then there's just those on the indices. So we're going to look at the broader equities put and call ratio and the volume thereof. Now, the way you read this is it's a bit of a contrarian, is that when the indicator is high, and I know this is on a daily basis, so what we've done is we smoothed a simple it's an annual 250-day moving average, and then I put an exponential moving average, 105, which is the 21-week moving average on the actual simple moving average. So we've got the blue line is the 252-day simple moving average. The green line is the exponential. We're looking for crossovers. So effectively, when this is high, so there are more puts being taken out. Let's just look at an example here. It's probably the best one, is the most recent. When there are more puts, this is and then the puts, as there are more calls and puts, the blue line starts to drop. So effectively, when the blue line is falling, it's indicating bull market conditions. So this is the S&P 500 down the bottom here, and you can see the S&P 500 dropping while the put-call ratio rises while the put-call ratio is dropping. So what we're looking for is for the put-call ratio, and when it's rising, the market should fall. So you can see over here, put-call ratio rising, market falls. So where are we at the moment? There was a good indication here back in the end of 2021 where the put-call ratio started rising, meaning more puts were being taken out by investors and calls, and that blue line started rising, the market started falling. So it was quite a good timing indicator. Now, you can go and spend hours looking at this. The problem with using this in a mechanical sense is that it's not always right. And sometimes it's wrong in a big way. So you couldn't say, I'm not getting in the market because this is rising. And the good example is over here. You can see there it was rising, and the market continued to rise as well. So you couldn't use this on a mechanical basis as a market risk type indicator, but you can certainly take it into consideration as a sentiment indicator and with a number of other sentiment indicators to form a view. So using this indicator to form a view is that this has not started turning down. What we want to see is something like this. We want to see the blue line start turning down like it did over there and crossing over the green line, which is its moving average. Now that hasn't happened. It's still above and still rising a bit, which is indicating that there are still more people in puts than there are in calls, and the investing fraternity is still, sentiment-wise, still a bit negative. When this starts turning down, that'll mean there are more calls being taken out than puts, and that's a more bullish, and we'll see that start falling, and then we'll have to see what happens with the price action. So on that one, it's certainly getting to probably oversold situations in terms of this indicator rising, but it hasn't turned over yet. So too early to call on that sentiment indicator to say, no, time to get really bullish. Okay, there's another indicator that I put on this to try and smooth this out, and I've put a Ciroc, which I did show you in the last update that I did. This Ciroc is of the moving average of the blue line. So there we've got 105-day moving average on the put-call ratio, and the simple average of the put-call ratio. And this Ciroc kind of smooths things out. So rather than, because moving averages cross over a bit more often than what you'd like, and you get the bit of whipsawing going on. So to try and smooth that out, I've put I think it's a 50, put a Ciroc on there, and you can see it as it's a 34.13. Yeah, it's a 34.13 Ciroc on the moving average. And you can see what we're looking for here is there when the Ciroc fell, then this was falling and the market rose. So there you are, that Ciroc falls, market rises. And that's because the put-call ratio is falling. Now, and then when this rose, the market rose a bit. So here's a good indication of, let's look at it, falling. Well, that's probably the best indication. The most recent one is when the Ciroc started rising because the put-call ratio was rising, the market fell. So what's happening now? Well, the Ciroc still hasn't turned over. So we're looking for the Ciroc to do something like this over here, to fall and cross below that blue shaded area. And that could, sentiment-wise, show us that the sentiment is turning to more bullish. So it's exactly the same chart, except all I've done is use the Ciroc to smooth out the whipsawing and the crossovers that occur on two moving averages. And that's available in for you to look at. You can download my analyses in Beyond Charts, and you can keep an eye on that. So we're looking for that to drop, the Ciroc to drop. Right, another sentiment indicator is the consumer discretionary versus consumer staples. This is really an indication. Consumer staples is seen as a safe haven, so people go into consumer staple type stocks, and utilities is also another one, just because there's big cash flow in utilities. But when the economy is more bullish, then people would go into spend more. There'd be more discretionary spend, and that obviously would push the discretionary stocks up, those that fit into the consumer discretionary sector. So when we compare the two, we can do some analysis on what the sentiment is in the economy. Even though the stock market doesn't necessarily follow the economy, it does tend to lead. So people, when they start getting a positive view on the economy, or think it's going to be positive 6 to 12 months down the track, you'll see the switch in the investing community from staples to discretionary. So let's analyze that. So this is the XLY ETF, and it's compared to the XLP ETF. So this is on the S&P 500. This is these are two spider sector ETFs, and those are the two that we're analyzing to see how XLY does compared to XLP, the consumer staples. Effectively, what I've done is a relative strength line here. So that's just a ratio between XLY and XLP. And basically, when XLY is outperforming XLP, when discretionary is outperforming staples, you'll see the blue line rising. And that's actually the XLY index or spider ETF. So that's not the market, that's the discretionary sector. And obviously, when staples starts outperforming discretionary, you'll see this blue line start falling. And then what I've done is put a Ciroc on the actual relative strength line. So that Ciroc is not of the price action on XLY. It's actually the Ciroc is of an indicator on the relative strength line, just to smooth out the little bumps and whipsaws that occur with these with two moving averages crossing over, a moving average crossing over more often than what an indicator would. So this smooth index rate of change is what the Ciroc is. And there was a sell signal. Let's just bring in the S&P 500. So now this is the S&P 500 chart down the bottom. You can now do that in Beyond Charts. You can actually put two price charts, and one on top of the other, or one below the other, and you can then line them up with value lines and such. So when that occurred back here, that was showing that the relative strength of the discretionary versus staples was getting weaker. So discretionary is getting weaker relative to staples, and we saw the Ciroc fall, and that was back in the end of 2021. And then what ensued was this market weakness in the S&P 500. Now, what we're looking for of the Ciroc is for it to rise, to jump above 10 or to rise above 10, and that would indicate that the Ciroc of the relative strength is showing that, relatively speaking, discretionary is doing better than staples. So the indicator to look at is the Ciroc rising above 10. And the time that the period setting that I have on that is kind of smooth, and that's then a sentiment indicator that things might start changing. Now, we've seen a bit of an uptick here because you can see the relative strength started rising. So in that little period over there, we had discretionary outperforming staples, and now we've just seen a little bit of weakness where staples are starting to outperform discretionary again, just towards the end. So we are looking for, as an indicator of this sentiment indicator, discretionary versus staples, for the Ciroc to rise above. Again, you can get this in Beyond Charts and keep an eye on it. Now, that is on the US market. On the ASX, we can do the same. What we're doing is we're comparing the discretionary, consumer discretionary versus consumer staples. Same, there's the relative strength line. There's the Ciroc of the relative strength line. And this here is the all ordinaries at the bottom. So you can see that from a relative strength perspective, that's the discretionary. Discretionary started falling before the all ordinary started falling, and the Ciroc fell, indicating that the consumer discretionary is underperforming consumer staples. What we have seen in the Australian market is discretionary start outperforming the staples, and that's why we had a little bit of positivity on the Australian market, and that is rising, although it's starting to flatten at the moment. And that is as a result of this relative strength line showing that discretionary started getting ahead in the Australian market. So maybe an early indicator in the Australian market compared to the US market. So that signal, if you like, that sentiment indicator is positive at the moment on the Australian market. Right, the next one I'm going to look at is comparing the NASDAQ to the S&P 500. And typically in bullish conditions, there is the NASDAQ is a growth index, and also has a lot of technical and biotech companies in there, a bit more speculative, and people are prepared to take more risk. So when the NASDAQ is outperforming the S&P 500, that's another indication of positive sentiment in the stock market. So let's have a look at that. I've done the same thing. So this blue line over here is just a ratio, a measurement between this is the NASDAQ composite in the top over here, and that is comparing it to the S&P 500. So when the blue line is rising, the NASDAQ is outperforming the S&P 500. When the blue line is falling, then the NASDAQ is underperforming the S&P 500. And then what I've done is put a smooth indicator, the Ciroc, on the relative strength line, just to make it far easier to detect these turns in sentiment of NASDAQ versus S&P 500. Let's bring it up to date, and you can see that this period of time over here, NASDAQ has been underperforming the S&P 500. That sell signal, if you like, occurred back here in the end of 2021 when the Ciroc dropped below its moving average, and it's pretty much an oversold territory now. You can see for the last 10 years, it's spent a much longer period of time in oversold territory here than it has for some time. What are we looking for here? We're looking for this blue, the Ciroc here, to rise above 10, above its moving average and above 10, and that will start indicating that the NASDAQ is starting to outperform the S&P 500, and there's a bit more of a risk-on sentiment in the stock market. It hasn't happened yet, so might say it's oversold, but that's another sentiment indicator to keep an eye on. Right, the last one to look at is S&P 500 versus S&P growth, which is really just a confirmation of the NASDAQ versus the S&P 500 for that growth. Similar thing I've done here, relative strength, S&P 500 growth, which is SGX, and the S&P 500 value is SPIV. Those are two indices, and you can see that similar sort of thing, sell signal occurred early in 2022, end of 2021, where growth started underperforming value. Ciroc gave the exit signal there, and it's still oversold at the moment. So we haven't seen a switch yet in sentiment from growth to value. What do we keep an eye on? The relative strength line, or a smoother version of that, the Ciroc of the relative strength line. So those 4 sentiment indicators, just to sum them up, are showing that we probably are oversold just by where the indicators are and how long they've been there. But at the same time, this switch to positive sentiment hasn't occurred yet. So we're still very much in a more negative risk-off mindset, looking at those sentiment indicators as measuring what's happening in the market. Last thing I want to look at is support zones on the major indices, S&P 500 and NASDAQ. Now, this chart is showing the breakouts that goes back to April 2013. So this is the entirety of the secular bull market that occurred, that's been running since April 2013. And if you think back to the 1930 to current chart, it's the top right-hand corner of the breakout since the last secular bear sideways market that we had from 2000 to 2013, secular bear breakout, April 2013 into secular bull, which is what we're in at the moment. And that's what we're looking at. So I put a Fibonacci line on here, and these blue rectangles show key support zones as shown as really taking the price action. So we've got high, breakout, support. So 4 or 5 touches on this line, and that is a key support zone for the S&P 500. The next support zone down from there is the top that we had before COVID-19 struck, or around about February 2020, and then the big fall COVID, back up, tested that zone, bounced off it and continued up. There's a double bottom. So that's another support zone. I've put dotted lines on that because it's below, but also has less touches than that one. This one should probably be a solid. It's got a lot of touches. 1, 2, 3, 4, 5, 6, 7, 8, 9, and probably 10, right? And that is was a resistance zone, now a support zone. That occurred back in 2018 and 19 and 20. So what are these Fibonacci's? There's a 38.2, a 50, and a 61.8 Fibonacci, and they kind of coincide with these price action support zones. Key support zone that needs to hold for this to remain in secular bull market territory. Now, so I've looked at sentiment indicators and looked at the long-term picture. Now we're looking at just pure price action, is we need to stay above this level over here. So what is that level? That level is, I think it's 2581, but that's the 38.2% retracement, and we've bounced off it a couple of times. So the maximum drawdown that the S&P 500 has had so far from peak to trough, and that's a dotted line, is 25.3%. As a threshold, if you like to keep an eye on, look for the minus 40% fall if we fall below this 38.2% retracement, which is around about 2890, and that's just below this 50% retracement level over here. So a minus 48% retracement, that's correct, it'll be down here. Now, why are we talking 40%? Because in previous secular bull markets, we haven't got to 40% fall. And when we have in secular bear markets, even the first fall, if you like, in the secular bear market is we've typically gone on, the market's typically gone on to hit close to 50% fall and beyond. So the odds are that if we get to a 40% fall, is that we're into secular bear market territory. And that on the S&P 500 is 2890 from that peak of 4818. So keep an eye on that number. From a charting perspective, if you're keeping an eye on the charts, again, this chart is available to you. You can download my analyses in Beyond Charts. You want that 38.2 is going to be transgressed first before the 40% happens. So that's going to happen, and then if it does fall below there, like it did there, we want to stay above a 40% fall, because if it gets below 40, it really is tickets. Sorry, the 40% fall is round about here. That's 2817. so slightly above the 61.8% Fibonacci retracement, so which will take it down to about there. That would be a pretty big fall, and if we fell below that, high probability the secular bear started. So we're still some time off that from a price perspective, and that minus 40% fall would take you well below that COVID peak, which was up there. So it's there'd be quite a few technical support and resistance price action alerts there that things are probably going to get worse. And of course, on the upside, if we don't fall below these support zones, and this is the maximum drawdown we have for some time, and if this market continues to rise, so we're looking at the flip side now, is if it fails to make a new high above 4819, and it keeps bumping its head there and does so 3 or 4 times, that's going to be an early indication that because the market's not advancing, not making a new high, is that the secular bull is going to struggle to continue. And if that's the case, and we see strong resistance at 4819 or there or thereabouts, and then it falls and has another big retracement, the odds are we'll be in secular bear market territory. So that's still some time off, but got to handle the flip side, the upside. I'm talking a lot about the downside at the moment, so we've got to handle what happens on the upside as well. The NASDAQ is the same. There's the 38.2, the 50, and 61.8. It's had a bigger run up than the S&P 500. So the 61.8% retracement is actually the COVID peak. It's around about where the COVID peak is. And it's had a deeper drawdown as well. It's had a 36.4% max drawdown down to these points. It's obviously above it at the moment. And a 40% would take it from where it currently is at 11.4 or thereabouts down to 9.727, which is down over here. Below there's the 10,000 to below that. That would be there would be pretty big fall in the odds that it might go bigger. But if it falls below 61.8 and this COVID peak, then it's going to be even worse. Then we're going to probably see a bigger fall. So I said all that. And of course, on the flip side, on the upside, if it finds support here, breaks out above the 38.2 and continues higher, making new highs, taking out all these previous peaks, when it gets up to here, which is 16,212, we have to see what happens there to see if the breakthrough happens, if the bulls outweigh the bears when we get to that key resistance, the previous all-time high, which occurred back at the end of 2021, November 2021. So that's it from a support zone perspective. So where to from here? Well, thresholds to watch are support levels that I've just gone through, and also the resistance level, the new high. 20 to 35% declines through a secular bull are quite okay. Historically, they've all happened. They've been there and are quite normal to have 2, 3 of these in the life of a secular bull market. 1987 crash happened in the middle of a secular bull market. 40 to 45% decline from a peak is not okay. If it falls that far, then it's a high probability it's going to go lower, and it's a high probability that the secular bull market has ended. Previous secular bull markets haven't had 40% declines. Of course, it's always the first, could have a 40% decline, and it's still a secular bull market, continues from then. We have a breakout to the upside, new all-time high, but the probabilities become stacked against you just looking at history. Keep an eye on the 14-month RSI to see if there's a fall below the lower thresholds, around about the 35 to 38 level on the 14-month RSI. The 4 sentiment indicators at the moment have not turned positive yet, and they will at some stage. It just depends on how positive that sentiment is and how far the price action goes as to how those will play out. But at the moment, they're showing oversold. And also look at stalling at the last all-time high if the price gets up there. So I can summarize from there that the secular bull market is still intact from now. Now, before I get into the others, Tim Lee was saying, look at the RSI divergence on the peak. I'm not going to do that now, but you can certainly look at divergence on the RSI relative to price action, i.e. if the RSI is falling and price is going up, or vice versa. If RSI is rising and price is falling, those are divergence signs. The first one is bearish, the second one is bullish. And you can look at that as well. It's another way of using RSI. And the other one is, okay, Chris is saying he's got it. Good stuff. Don't need to answer that. So all intact for the time being, based on price action to date. Of course, price action continues moving, and that's why we need to reassess this. As I said, a quarterly is okay, but certainly we shouldn't be going beyond 6 monthly with doing this kind of analysis. But keep an eye on those thresholds if you want to stay intact with what's going on live, if you like. And if all those thresholds are in place, see the big picture. Understand that you maybe shouldn't be knee-jerk reaction to noise. I think one of the things that I haven't said and put on the charts here so far is just how much negativity this market has taken. And you could say, relatively speaking, that with such loud noise that's been going on, that it's probably surprising that it's held up and been as strong as it has. We would have expected, certainly in a secular bear market, if we were in one, such negative news would have seen far bigger falls in the indices. And so there's another sentiment indicator, if you like, is that just taking the relativity of the wall of worry versus the price action support levels and how the indices are reacting, is that relatively the even though the market's down, is that it's been positive relative to the huge amount of negativity that's been flowing around the world for some 18 months now. Where to from here? Well, nobody can predict. It's pure folly. We don't want to get into predicting. You just end up using different kinds of analyses and different kinds of criteria and different views and opinions and conjecture, and all that does is from one day to the next, you got one set of variables pulling you from pillar to post, and you got a totally different set of variables pulling you from pillar to post the next day. It's that we don't want to react to the noise. We want to go to some principled way of analyzing what's going on. And for me, and what we do here at Sharewell Systems and many tens of thousands elsewhere around the world, that's the price action. We go to the price action to keep us objective and on the straight and narrow. We go to the price action to overcome our emotions, and the more rigorous we can become with our analysis of price action, and the word for that we use is mechanical, and putting a decision support system in that is as mechanized and as objective and as possible, the easier it is to make decisions without letting the noise and the fear overcome us. And what happens is when you open to noise and doubt and fear and opinions and conjecture, is that you just continue changing your decision criteria for whether to buy, hold, or sell, and that makes you inconsistent and subjective, and that ends up that's just not a winning way of anything, let alone in the market. Certainly in business, sport, whatever it is, that's not the way to be running a successful business or team or even a stock market portfolio. Short-term volatility is the biggest killer of long-term goals. There's undoubtedly in the market that is just so true. And we have to find a way, when we start feeling like we're reacting to the noise and the conjecture and the opinion around short-term volatility, we have to find something to go back to. We have to find our solace, our stalwart, our principles, and step back at big picture. And that's what this is about. That's what I'm trying to do here. But at the same time, we have to be vigilant in the short term. And how do we do that? Well, the story is that we use a mechanical decision support system to do that rather than reacting to noise. And how do you put together a mechanical decision support system? Well, it's part of a plan. And that plan has a vision statement, it has a goals and objective statement, it has a method to help you make your decisions. It covers risk management and money management. And it stipulates and writes out in full what your processes, what your procedures are, what you do on a day-to-day basis, what your vigilance is, attending these or even doing this analysis yourself that I'm doing here today, every 3 to 6 months. And that's part of the process. It's part of your process plan, your procedures to do that. And you can write that into your plan, and then you can do it, and you can even set alarms to do it in your calendars. We've got all the tools around to do it. And then once you've actually put that plan in place to handle whatever happens, so you don't have to be worrying about the future, you don't have to worry about the wall of worry, is you to say, come what may, my plan handles it, and then I'm going to trust it and execute it. And that's what allows us to sleep at night and be able to handle this caper with a rising equity curve with acceptable drawdowns is effectively what we're trying to achieve that outperforms the market. So we don't want on-the-fly prediction. This quote, which I'm going to keep repeating to you because I think it's so applicable, is expect the best, plan for the worst, and prepare to be surprised on the upside and the downside. So expect the best, plan for the worst, but we've got to do that first, plan for the worst, and then expect the best. And we know, markets, give us your worst, throw your worst at us, and I've got it handled. I've got a plan in place to handle it. So how do we prepare for this? Well, what are the best strategies for a secular bear market? If a secular bear market is around the corner, and to do some planning and just to, rather than just fear it and get stunned and caught in the headlights like a deer at night or a kangaroo at night, let's do some thinking. Let's do some scenario planning. What are the best strategies for a secular bear market? Is it buy and hold index ETFs, which are going to wear the full brunt of a 50% plus fall? Is it buy and hold stocks, which we know, like CBA, fell over 70% in during the GFC? Probably one of the stalwart stocks in the Australian market. And there's so many other stocks that fell 80-90%. The NASDAQ itself in the 2001, 2002 bear market, the index, the NASDAQ 100, fell 82%, right? And if you're in the triple Q ETF, that's what could happen. Or if you're in stocks that make up the NASDAQ 100, some could, to get for an average to fall, market average, a market index to fall 82%, there must have been a whole bunch of stocks that fell more than 82%. So is it buy and hold stocks in a secular bear? Is it balanced funds? We know that the biggest problem with balanced funds is not how they handle a bear market, it's how they handle a bull market. And they are perennial underperformance because over diversification just handbrakes and stifles their returns. And sure, they'll have much lower drawdowns in a secular bear market than a direct stocks or ETFs type portfolio. But along the way in the secular bull market, they're massively underperform. And so that's risk versus reward. So how do you prepare for a secular bear market? Do you use discretionary, intuitive, and subjective active investment? Do you just go on your gut and hold CBA or the banks, come what may, right through? Well, what's happening at the moment with banks, I'm not saying Australian banks are far more protected and are far more diversified in their assets and how they raise their capital than some of the US banks. And we know US banks get very sectorized and focus on just particular parts of the economy, and hence their diversification, their over leverage ends up with what's happened in the last week or so. But that so you could say, well, CBA it'll always come back, even if it has another 70% fall. But it would be far better for your money not to have had that 70% fall, and it'd be far better for your brain and your psyche not to have sat through it as well. So we have to have a way of planning for the worst. Plan for the worst, expect the best, prepare to be surprised. So how do we do this? We want to avoid most of each large primary bear market, which happen in both secular bull and bear markets, and we want to minimize exposure during these, and we want to make the most of primary bull markets, and we want to maximize exposure in those. So it's a risk management, money management thing, as well as a decision support system of what to be in and when to be in it. And I remind you of the second part of a quote that Warren Buffett made back in the 1950s. He basically said that he would want to outperform in a bear market, but in a year when the general market had a substantial advance, I would be well satisfied to match the advance of averages. So to match the advance of averages when the markets go up, but to massively outperform when the market goes down. And he obviously uses fundamental analysis to do that, to pick the stocks that are going to go down by less, if you like, and relatively to outperform, but still to have drawdown, because we know we know Berkshire Hathaway has had 50% drawdowns in its equity curve. It's a listed company, and we can see that. But we want to outperform in a primary bear market, and by minimizing exposure and being in cash. So let's have a look at the last secular bear market. Now we don't have SPA3 Investor wasn't around back in the last secular bear market, but SPA3 Trader was. And so I'm just going to show you quickly the SPA3 Trader, how it handled the last secular bear market. We can see this is 2008. The black line here is the All Ordinaries Index. That's not the All Ordinaries Accumulation Index. I'll show you that in a moment. That's the All Ordinaries Index. The red line shows this starts in 2001, January 2001, and goes through to April 2013 there where the breakout occurred. And SPA3 Trader, which is a pretty active methodology, but still a mechanical decision support system, it went down by less in the bear markets. That's in 2001, 2002, that's 2008, by really minimizing exposure to the market. It still had drawdown. That drawdown doesn't look so deep, but it was still, I think, a 20% drawdown that it had in that period. It certainly wasn't the 50 or was a 19% drawdown. It wasn't a 56% or 54% drawdown in the All Ordinaries, but we still minimized cash, but we maximized the rise. And there we did a slight bit of outperformance. And then this is where the secular bull market started again in the US. And we've had this rise, and we've kind of matched to slightly underperformed in some periods. But we've also minimized that kind of drawdown over there. I think that was a 22 or 23% drawdown there in this 33% drawdown here. So we still have drawdowns, but we have acceptable drawdowns. We're not going to eliminate drawdowns altogether, but we want to get this rising equity curve, and we want to handle these secular bear markets. So why am I showing you this? Because that's what we'd anticipate SPA3 Investor to be able to handle in a similar manner. We're going to have a 20, maybe a 25% or even a 28% drawdown in a 56% or a 60 or even a 72% drawdown in the NASDAQ or 82% drawdown in the NASDAQ 100. We're going to minimize it, but we're not going to eliminate it. And we want to be set to, we're not going to have a 60% loss or a 70% loss in CBA, for instance. So we want to minimize it and outperform relatively in the bear markets. And then the up legs that we have, because that's 2003 to 2007, and that there is 2009 to 2013. We want to at least match the index in those periods. This is versus the accumulation index, pretty similar. The breakouts, the outperformance wasn't as much, obviously, because the accumulation index has dividends in it as well, but you can still see that outperformance in there. So secular bear we are prepared for, well and truly prepared for, with SPA3 Trader and SPA3 Investor. How did SPA3 Trader go versus the S&P 500 index? So there's the secular bear market. Same thing. We got this protection by minimizing exposure in the market, and that's what we want to do. So we are well and truly prepared for the secular bear market. And that's the message I want to get you to have that secular bear market, bull market cycle in your head, and then have a plan to be able to handle both. And if you can match to slightly outperform or even slightly underperform the secular bull market, but then massively outperform, relatively speaking, in the secular bear market, then what have you got to fear? Because you've got your plan in place, you just got to execute it. And you can bring on the bear, because you know that in the up legs that we have in the secular bear, we'll be ready to take those on as well, rather than wear the full drawdown with, say, for instance, buy and hold index, and also then sure, you wear the whole run up as well, but net over the period of time, over this maybe 13 years, you end up either net break even rather than well ahead if you prepare for it and have a plan. So this book is something that I know many of our clients now have read it. This was published about a year ago. You can get that in the Education Center. It goes through a lot of this material and understands the whys and wherefores behind. For prospective clients who get to see this over the coming weeks, you can go to sharewealthsystems.com/book-offer, and you will be able to get that book there. Summary: the secular bull market is well and truly still intact. It's, of course, but anything can happen. So we don't rest on our laurels. We remain vigilant. We have our plan in place. We revise our investment plan. We have a look at it every 6 months. We update it, and you avail yourself to information like this. You get training. You keep on training. You work on your psychology. You get better at overcoming, the fears that surround the market. And you keep saying to yourself, which is fundamental truth number 2 from Mark Douglas's 5 fundamental truths, is you do not need to know what will happen next to make money in the market. Anything can happen. You do not need to know what will happen next to make money in the market. Expect 10 to 35% falls during a secular bull market. They are quite normal. Be prepared for them psychologically. You will have drawdown in your equity curve, but then also be prepared for the run-ups that occur after that. in the secular bull market and in the secular bear market as well. Those run-ups will occur, and we need to be prepared for those. Summary: understand the big picture of long-term market cycles, secular bull and bear market cycles. We're still in a secular bull market cycle, and put that picture in your head. It's an important one. Keep it in your mind's eye at all times. Get that perspective. It should be an overriding theme to all your investing. The best way to take advantage of the opportunity stream is to stay in the game. You can't take advantage of the endless opportunity stream of the stock market if you're sitting on the sidelines watching the game. Sure, you won't get tackled by sitting on the sidelines, but you also won't get the benefits and the feelings that come with winning in the stock market as well. So you're going to overcome the noise. You're going to overcome the 4 primary fears, which if you are subjective and you are inconsistent, you are going to experience those 4 primary fears. What are they? They are missing out, losing, they're being wrong, and leaving money on the table, as per Mark Douglas. So how do you overcome those? How do you overcome the noise? You use a systemized process, a mechanical decision support system. As Mark Douglas said, it's the only way that he knows to get your psyche and your psychology in tune with the market, to become empathetic with the market, to be and feel the market, is to use a mechanical system and to get rid of that societal paradigm and move towards a market paradigm. And for our clients, I'm reminding you of that. That's part of our job, our accountability here as your accountability buddies, is to keep reminding you of that, because it's tough times at the moment, and you've got to go back to your principles, go back to your stalwart, go back to your plan, and keep on reading your plan, reading the plan that you put together when you were out of the feelings that you may have when the market's negative, and stick for the long term. And for those of you that are our clients, we've now made the systemized investing program available to all our existing clients. If you are a prospective client, then you can certainly Google that, or you can talk to us about doing the systemized investing program. Right. Some questions we have here, just some thank yous. Thank you. Good. Thank you very much for your feedback. There we go. Okay. All thanks. No questions. Hopefully I've covered all the questions. I'm going to end it there. This recording will be available for you to watch and rewatch over the coming days, weeks, and months. Thank you for your attention. And as always, I wish you consistent and objective investing.